Okay, let's unpack this. If you are, reading any financial news, looking at tech headlines, or simply watching your own retirement portfolio, there is one word that is just dominating everything: AI. We are living through this incredible hype cycle: generative AI, large language models, LLMs, and this relentless promise that this is a technological supercycle, the one that's destined to mint trillions in new wealth and justify these huge multi-trillion-dollar valuations we're seeing.
It really is the dominant conversation. But, we have to ask the hard question. Is all this exuberance actually warranted by the underlying financial facts? What's fascinating here, and what our sources really dig into, is the sheer tension between that market sentiment and the engineering rigor that you'd need to validate these claims.
Absolutely. And for this deep dive, we received an incredible stack of analysis. In-depth reports inspired by a really stark thesis that was first published by the Wall Street Journal. And it suggests something, well, pretty counterintuitive.
It really is. The headline was, AI is making big tech weaker.
Exactly. And that thesis is the ultimate hook, right? Because it forces us to look beyond just the soaring stock prices. We aren't talking about companies like Alphabet or Amazon or Microsoft actually failing. They're still behemoths.
Of course. They're not going anywhere tomorrow.
But the data, the numbers, they suggest their foundational financial strength is actually eroding because of this AI pursuit. The evidence is, frankly, alarming. Their massive capital expenditures, the CapEx required for AI infrastructure, they're projected to consume just a terrifying amount of their free cash flow, or FCF.
And the analysis we have forecasts a staggering 94% FCF erosion. That's across the major hyperscalers, and that's by 2025.
94%?
That statistic it's a siren call.
It's
really
sad.
is. It suggests a fundamental identity crisis for these companies. They were celebrated for their ability to generate cash so efficiently.
They were cash machines. That's what they were.
Pure cash machines. If 94% of that cash is immediately consumed by building infrastructure, their financial profile just instantly shifts. They go from being these asset-light, high-margin software businesses, the ideal growth stocks, to capital-intensive utilities.
And that right there, that defines our mission today. Our deep dive is to cut straight through all the financial and media hype to really analyze the structural engineering and the economic facts that are underpinning what more and more people are calling the AI infrastructure super bubble.
And to do that, we have to bring in the science.
Exactly. We are specifically integrating the in-depth R&D insights of Dr. Professor Yogesh Malhotra. His critical scientific framework provides an objective and I think a necessary lens for understanding this unprecedented market moment.
We absolutely have to shift the focus. It has to move away from market optimism and toward engineering rigor. Dr. Malhotra's critiques, which have been developed over decades of R&D and are extensively documented, they assert something pretty damning. They say the critical, fatal limitations of the current AI paradigm, what he scientifically defines as backward AI, make a financial burst, rooted in technical obsolescence. Not a question of if it will, but only when it will.
And that really brings us to the core question we're tackling today. Is this a sustainable supercycle that's built on real, forward AI technology and guaranteed returns? Or are trillions of investment dollars resting on fundamentally obsolete, correlation-based technology and, unprecedented levels of corporate debt?
And the risk profile here is it's extreme. According to analyses that cite IMF estimates, we are looking at a projected $35 trillion wealth evaporation if this bubble bursts.
35 trillion. Let's just pause on that.
Yeah. And to put that into perspective for you, that figure is 7 times larger than the estimated $5 trillion that was wiped out during the dot-com crash just over 2 decades ago. This isn't just a normal market fluctuation we're talking about. This suggests a systemic risk that's being amplified by flaws at the technical core of the entire investment thesis.
So we need to start by dissecting the financial anatomy of this situation because the numbers, as staggering as they are, they really do reveal the pressure points.
They tell the whole story.
Let's start section 1 with that headline statistic, the one that initiated this whole line of inquiry for us, the strain on the balance sheet. The analysis, inspired by that WSJ report, states that AI CapEx is consuming 94% of free cash flow across the major hyperscalers: Alphabet, Amazon, Meta, Microsoft, and Oracle in 2025. It's just breathtaking.
It is the single most important number to understand. Free cash flow, or FCF, is, to put it simply, it's the cash a company generates after paying for its day-to-day operations and all its mandatory maintenance expenses.
It's the good stuff, the money left over.
It's the good stuff. It's the money that's available. for dividends, for stock buybacks, or for, future higher ROI investments. And for decades, investors loved these tech giants because their FCF was massive and it was always growing. It was proof that they were highly scalable without needing constant heavy reinvestment in physical assets.
And now that FCF is being, just vacuumed up by capital expenditures?
Correct. And CapEx is the money spent on acquiring or upgrading physical, long-lived assets. The GPUs, the networking gear, these massive data centers. So if 94% of your FCF is going toward CapEx, you are by definition no longer a high-margin software business. You're a capital-intensive utility. And utilities are, they're stable, they're predictable, they're necessary, but they are not the explosive growth drivers that are supposed to justify these trillion-dollar AI valuations.
The spending spree itself, the numbers detail the sheer magnitude of this bet. The sources project $320 billion in hyperscaler CapEx in 2025 alone.
$320 billion.
Just to put that figure in context, that is approaching the entire GDP of countries like Denmark or Thailand, being poured into physical infrastructure in a single year by just 5 companies.
And this spending is creating an enormous debt trap. Because if your FCF is already consumed, where do you get the money for that $320 billion?
You have to borrow it.
You turn to the debt markets. The analysis highlights a collective debt increase of $141 billion among these core players.
Let's use Oracle as a specific example from the source material. It notes they're nearing $96 billion in total debt. $96 billion. That is a colossal liability for a tech company.
It completely changes their risk profile. It has to. When CapEx outstrips your FCF, the company has to raise money externally. And this is where the mechanism bridging that CapEx FCF gap becomes really critical and, frankly, controversial. We see companies utilizing these off-balance sheet vehicles, specifically special purpose vehicles or SPVs, to finance these massive data center and infrastructure bets.
Okay, for listeners who aren't, steeped in complex corporate finance, can you break that down? What exactly is an SPV, and why does its use in this context raise so many red flags?
Sure. An SPV is essentially a shell company. It's created to hold specific assets and liabilities, and they are legally distinct from the parent company. In theory, they're used to isolate risk. For instance, if you want to finance a massive single data center project, you can set up an SPV. The SPV takes on the debt for that project, and that debt doesn't immediately appear on the parent company's main balance sheet.
So it makes the parent company look less levered, more financially pristine to investors, at least on the surface.
On the surface, exactly. The immediate financial health metrics, like your debt-to-equity ratios, they remain artificially low, even though the parent company is ultimately on the book for that debt.
And critics are making some pretty pointed comparisons.
They are. They're making comparisons to accounting maneuvers used during the Enron era, where risk and debt were systematically obscured from investors. Morgan Stanley even noted that early in this boom, leaders like Meta's Mark Zuckerberg were funding AI infrastructure using internal cash flow. But as the spending accelerated, the reliance on debt and, crucially, these off-balance sheet vehicles, it just grew and grew. This introduces opacity and fragility, especially in a rising interest rate environment where servicing nearly $100 billion in debt, like Oracle faces, becomes a huge drag on the business.
Which leads us directly to the central and I think most damning conflict here, the ROI paradox. We've established this breathtaking commitment of capital $560 billion in total CapEx spend over the relevant period, yet the analysis cites only about $35 billion in new verifiable AI revenue.
That is a colossal mismatch. Just think about those numbers. To put that into perspective for you, that $525 billion gap between spend and revenue, it signals that the collective return on that investment, based purely on new AI sales, is less than 7%.
Less than 7%.
Right. And when you are betting on a revolutionary technology that promises to transform the entire world, you don't expect utility-level returns. You expect exponential growth. The fact that the revenue being generated is so marginal compared to the massive investment, it signals deep, deep structural problems.
But surely the companies would argue this is just a necessary foundational investment, right? That the revenue will follow in 3, 5, maybe 10 years. Is there any evidence backing up that future promise?
Well, that's the key question. And unfortunately, the independent evidence that's available today suggests the exact opposite. The sources highlight an MIT study that found a staggering 95% of companies adopting AI see zero verifiable return on investment on their pilot programs.
95%. So this isn't just a low return. This is essentially a total failure rate for the adopters.
It's a failure rate. If 95% of the customers of these hyperscalers cannot generate any value from the products they're buying, then the financial foundation of the entire AI infrastructure build-out is, well, it's suspect to say the least.
So if 95% of adopters are seeing zero return and the hyperscalers are spending hundreds of billions for these tiny marginal revenue increases, how does this amplify the bubble risk beyond just traditional metrics?
It amplifies the risk exponentially because it exposes the financial system to extreme nonlinear tail risks. And this is where Dr. Malhotra's analysis on systemic fragility becomes so incredibly pertinent. His SSRN-validated critiques, they focus heavily on exposing the inadequacy of traditional risk models. Models like value at risk or VAR.
And VAR is the standard model that financial institutions use to predict their potential losses.
Exactly. But VAR is notoriously inadequate for handling black swan events or, extreme outcomes, the so-called tails of the probability distribution. Malhotra's research specifically addresses the systemic volatility associated with the $700 trillion plus in derivatives tails that are currently lurking in the global financial system.
700 trillion. It's an astronomical number.
It is. It highlights the systemic interconnectedness that makes the risk so much greater than what we saw in the dot-com era. When these hyperscalers are suddenly downgraded because of their debt strains, that contagion ripples through the derivatives market, and the VAR models will fail just spectacularly to predict the outcome.
And this suggests a deep financial fragility. You also mentioned circular financing loops.
Yes, these loops are masking the technical obsolescence, and they're inflating the perceived demand. For instance, you have the venture arms of big tech or their partners, like NVIDIA, injecting capital into AI startups like OpenAI, who then turn around and buy the very hardware and cloud services provided by those same investors. It creates this self-licking ice cream cone of demand that isn't rooted in any real end-user ROI.
So when the FCF is consumed by CapEx, investors are forced to stop looking at simple FCF yield. They have to look instead at measures like return on invested capital or ROIC and debt sustainability.
This is the essential paradigm shift. Investors must now treat big tech as AI utilities, companies with huge capital requirements and constrained growth profiles, rather than the agile tech innovators they used to be. And this structural reevaluation, which is spurred by the debt and the absolute lack of ROI, is precisely why that WSJ thesis, that AI is making big tech weaker, holds such immense weight. The financial rot signals a deeper technical flaw, and that is where we need to pivot now.
Right. We've established the dire financial symptoms, massive debt, FCF erosion, and that 95% zero ROI failure rate among adopters. So now we have to address the root cause, which Dr. Malhotra argues is a fundamental, predictable engineering flaw in the technology itself. This brings us to his technical classification, backward AI.
This is the absolute core of the scientific argument. Dr. Malhotra's research defines the current dominant paradigm, so generative AI, LLMs, machine learning, as backward AI because of their foundational architecture. And it's important to stress this is a scientific classification, not just a market judgment.
So what exactly is the mechanism of this backward AI? What makes it so fundamentally flawed for high-stakes, real-world deployment?
The core flaw is that these systems are inherently reactive. They depend entirely on history. They rely on finding historical correlations within vast data sets, using complex statistical methods like stochastic gradient descent, that's SGD, and backpropagation. Essentially, backward AI uses what's called goal-driven inference. It starts with a hypothesis, a correlation it found in the past data, and then it attempts to validate it with facts. It's extrapolating from what has been, not anticipating what will be.
To put it simply, they're excellent data aggregators, but they are not thinking machines.
Precisely. As Dr. Malhotra noted in one of his LinkedIn Pulse articles, AI has nothing to do with meaning, thinking, reasoning. So if the environment is dynamic or non-deterministic or involves any genuine novelty, the system is predictably designed to fail. And that right there is the scientific explanation for why 95% of these pilot programs show zero ROI.
Okay, let's slow down here and really explain the engineering shortcomings that guarantee this failure. Let's start with the brittleness that's inherent in the learning process. What is stochastic gradient descent, SGD, and why does it lead to such instability?
Okay, so SGD is the mathematical optimization technique that's used to train these massive models. Imagine you were trying to find the lowest point in a vast, bumpy valley. That valley is the loss function. And you want to make your model as accurate as possible. You can't see the whole valley at once. You can only take small steps based on the local slope of the current data point you're standing on. That, in essence, is SGD.
So you're constantly taking these educated, tiny little steps toward what you hope is the optimal solution.
Yes, but the research shows this process is fundamentally unstable, or what we call brittle. Dr. Malhotra's work describes it as oscillating, like a rudder in a storm. Because the system is only basing its direction on localized historical data, it's constantly overcorrecting. And when complex data sets or non-standard inputs are introduced, what we call adversarial attacks or just genuine real-world complexity, the system encounters something called vanishing gradients.
Vanishing gradients. That sounds like a very technical way of saying the system just gives up.
That's effectively what it means. The error signals that are used to adjust the model's weights during backpropagation, they become so small they're practically zero. So the learning or the optimization process, it just halts entirely. The model can no longer adapt or improve. And this brittleness means these systems cannot handle genuine surprise or novelty, which is, by definition, a black swan event.
And this inherent limitation, it links right back to that classic philosophical problem of correlation versus causation.
Absolutely. Backward AI excels at correlation. If A has frequently followed B in the past, the model assumes B causes A. But it fails entirely when it's confronted with environments that are defined by quantum uncertainty, which means non-eliminable randomness and time-space complexity. Think of flash crashes in high-frequency trading where novel conditions emerge in milliseconds, or large-scale supply chain shocks. The system just rehashes historical correlations, which, by definition, fail precisely when true foresight is required the most.
So the $320 billion in CapEx is pouring money into GPUs and data centers that are optimized for running.
Well, fundamentally limited math. Math that is designed to break under stress.
It is what the research terms misinvestments. Silicon Valley and Wall Street are prioritizing immediate speculation, which is driven by FOMO and this, vague promise of AGI over rigorous R&D and engineering truth. They're betting massive corporate debt on an architecture that fundamentally cannot deliver sustainable, resilient value. And the result of that bet is what's called the scaling wall.
What do you mean by the scaling wall? The inherent limitations of backward AI mean that to get even marginal improvements in performance, say moving the accuracy from 85% to 88%, you have to exponentially increase the data, the computational resources, and the energy consumption. This is the core driver of that $320 billion CapEx spree. They are overspending wildly on infrastructure because the technology itself is hitting diminishing returns. They're building these massive, power-hungry data centers, the dark side data centers we'll discuss in the next section, to try and compensate for a mathematical dead end.
So the technical obsolescence of SGD and this reliance on correlation is the direct scientific explanation for why the ROI is so suspect and why this bubble is unique.
It is the scientific hammer blow. The models lack the structural ability to generate value in non-deterministic environments. The financial crisis isn't an external shock waiting to happen. It's an internal, predictable failure that is guaranteed by the chosen engineering path. And the inability to handle anticipation of the surprise makes the entire financial system vulnerable, ensuring that the projected $35 trillion crash isn't just a market correction. It's a systemic collapse caused by brittle, dumb systems operating at an unprecedented scale.
That distinction, a predictable failure of engineering rather than just a random external shock, that's critical. To really fully grasp the danger here, we have to compare this moment to the dot-com crash of the early 2000s. I mean, that event was devastating. $5 trillion lost, a 78% NASDAQ drop, all driven by vaporware and equity speculation.
And the analysis we have calls the current situation the super bubble of super bubbles because the potential damage is so much larger. We're talking 7x to 17x the size, wiping out somewhere between $35 and $40 trillion. And while the dot-com boom was based on hopeful but unproven business models, the AI boom layers that hype with two new and highly toxic elements, massive debt and guaranteed technical obsolescence.
Let's compare the CapEx frenzy directly. We know both bubbles saw CapEx peak near 4.5% of GDP, which indicates a pretty similar investment fever, but the nature of the overcapacity is different this time. The dot-com crash left behind 85% idle fiber, the famous dark fiber that nobody was using.
Right. And today, the investment is creating what is projected to be $2 trillion in overcapacity in so-called dark side data centers. These data centers are built to house the GPUs and the networking gear needed for backward AI. But if that AI fails to generate ROI, which, remember, 95% of pilots prove it does, you are left with incredibly expensive power and water-consuming physical assets that are essentially worthless. They're worthless because the technology they were built to support is fundamentally flawed.
So the ghosts of dark fiber are reappearing as dark beta centers, but this time they're exponentially larger and more expensive to maintain.
Exactly. It shows the market is making the exact same mistake, but on a dramatically larger scale. It's building massive infrastructure to compensate for a technological limit, that scaling wall of backward AI.
But the financing model shift is perhaps the most alarming structural difference between the two eras. .com was equity heavy. It was driven by VC money and over 400 IPOs, so the losses were primarily absorbed by professional venture capital and tech-focused funds.
And the AI boom, as we detailed back in Section 1, is debt-laden. It is being funded by an unprecedented surge in corporate debt, the hyperscalers' $141 billion debt increase, and the use of opaque SPVs. This makes the system far more fragile because debt is unforgiving. Equity losses are painful, but debt failure leads to bankruptcies and systemic contagion. The nexus of Silicon Valley and Wall Street has taken the engineering risk betting on obsolete technology, and they've amplified it using these highly leveraged debt instruments.
And this leads to what is maybe the most cynical aspect of the current moment, the nexus and Main Street devastation. This isn't just rich people losing paper money. This is systemic coercion against the average worker, the average investor.
This is the critical moral hazard. The analysis highlights an unprecedented Silicon Valley-Wall Street nexus, which is deeply intertwined with governmental policy. This nexus benefits from specific tax incentives for AI R&D, coupled with very lax antitrust enforcement, which creates a kind of closed system.
Yeah.
The purpose of this system, critics argue, is to coerce Main Street into funding billionaire gambles while shielding the elite from full exposure.
How does this coercion actually happen? I mean, how is the average listener funding this boom without even realizing the risks they're taking on?
Through their retirement funds. It's that simple. Our sources highlight the devastating exposure of the average retail investor. Nearly 80% of 401ks are exposed via S&P index coercion. Just think about the Magnificent Seven companies, the core players in this AI boom. They account for around 30% of the entire S&P 500's market capitalization weight.
So if you own an index fund, which almost every single retirement account does, you are compelled to buy into the most leveraged, highest risk components of this AI super bubble. It doesn't matter whether you personally believe in the technology or the valuation.
Precisely. You are passively exposed to the failure of backward AI. The dynamic is textbook. Socialize the risk, privatize the upside. Unlike the .com era, where index exposure to tech was far less concentrated, this boom is embedded directly into the retirement structure of ordinary Americans. When the bubble bursts, the contagion will hit retail investors disproportionately hard.
And that shift from, an organic frenzy to what sounds like policy-backed greed, it just guarantees a harder, more pervasive crash.
The scale guarantees devastation. Analysts are projecting not just financial losses, but a potential jobs apocalypse, as the trillions in these misinvestments lead to widespread corporate restructuring. Because the financial foundation backward AI is flawed, the spending is unsustainable, and the exposure to Main Street is mandatory, the resulting crash will be far more widespread and severe than anything we've seen since the 1930s. The trillions being poured into obsolete technology backed by debt ensure a catastrophic reckoning.
It is clear that the financial collapse is a predictable outcome of the structural flaws in backward AI. So what is the antidote? If the current paradigm GenAI-LLMs machine learning is inherently correlation-based and brittle, what does the necessary engineering pivot actually look like? This brings us to Dr. Malhotra's solution, quantum-augmented self-adaptive networks, or QASNs, which he defines as the forward AI imperative.
QASNs represent the shift. It's the shift from reactive historical correlation to proactive, causation-driven anticipation of surprise. It is the non-deterministic solution designed specifically to overcome the fatal limitations we detailed back in Section 2. It's the framework that is required for generating resilient, sustainable ROI in what he calls the post-AI quantum era.
And before we dive into the technical details, it is important to note that this isn't just some academic theory. Our sources point out that even the systems driving the current hype recognize the rigor of this work. xAI's Grok AI, for instance, reportedly deemed QASNs decades ahead of GenAI and LLMs. It also recognized Dr. Malhotra as the singular post-AI quantum pioneer, with R&D that dates all the way back to 1993.
That validation is crucial. It really is. It signals a major disconnect. The technology industry is heavily invested in one path, backward AI, while simultaneously acknowledging that the path to true, sustainable intelligence lies elsewhere, with QASNs. The scientific framework for forward AI is established. The capital just hasn't pivoted to it yet.
Okay, so let's break down the key technical features of Kiyosan's. What makes forward AI fundamentally different from these brittle correlation-based systems?
We can define it across three dimensions. First, and most importantly, it is causation-driven. This is the leap from just pattern recognition to genuine understanding. Backward AI asks, what happened? Forward AI asks, why did it happen? And what novel, nonlinear consequence might follow? It uses causation-driven anticipation of surprise modeling, which allows it to predict events that have never occurred in the training data, like black swans.
So instead of breaking when a surprise occurs, it's actually designed to recognize the potential for surprise and then adapt accordingly.
Exactly. It operates on non-deterministic principles. Second, K-SANs integrate quantum superposition and quantum parallelism. Now, this is not just about using quantum computers, though that's part of the future. It's about applying quantum principles to information processing. Classical machine learning is constrained by binary logic and backpropagation. By integrating quantum parallelism, K-SANs can explore multiple states and high-dimensional stochastics simultaneously, which is essential for modeling things like complex financial markets or global climate systems.
And that integration with human sense-making is key to achieving resilience, isn't it?
It is the third dimension,
Yeah.
the ability to achieve the elusive agility, resilience, and sustainability trilemma. Backward systems are rigid. They require massive power for marginal gains. QA-SANs integrate human intelligence and feedback loops, allowing them to self-adapt and reconfigure in real time. This means they are resilient. They learn from and survive extreme events, and they offer massive efficiency gains.
Let's talk about the economic impact of that. What does this scientific shift mean for ROI, for moving from the current suspect returns to what Dr. Malhotra terms assured ROI?
The potential is transformative, which is probably why the Nexus is fighting it so hard. Backward AI is struggling to justify its initial costs, which is what leads to that 95% zero ROI rate. Forward AI, because of its efficiency and its accuracy, is projected to offer stunning financial benefits, including 90 to 99% cost savings due to energy efficiency and accuracy. This translates into generating trillions in resilient value in adaptive finance, in cybersecurity, and in logistics. The economic breakthrough is rooted in superior engineering, not speculation.
Looking ahead to the post-crash environment, the period after the $35 trillion wipeout, how do QI-SANs become essential for future testing these non-deterministic markets?
They will be the only systems capable of survival and growth. For finance, QI-SANs enable model risk arbitrage beyond VAR and expected shortfall, ES. If traditional VAR fails to account for the $700 trillion in derivatives tails, only a causation-based quantum-augmented system can provide the necessary foresight. Without QI-SANs, institutions will face perpetual systemic risk from their brittle modeling.
Can you give us some concrete applications for the listener?
Sure. Think about cyber-resilient trading. QI-SANs can dynamically model and preempt the flash crashes and systemic failures that could trigger a massive market collapse. We're also talking about quantum-secure crypto and finance, which will be protected against both current and future adversarial attacks, and, more generally, self-adaptive logistics and geopolitical modeling that won't just freeze up when geopolitical shifts or massive grid failures occur. Dr. Malhotra's R&D provides the technical blueprint for the next sustainable phase of the economy.
So the cruelest irony of this entire super bubble is that the $320 billion in CapEx for 2025 is being poured into an obsolescent foundation, while the scientifically validated, resilient path forward AI is being ignored by the Nexus.
It's the ultimate misinvestment. The market, driven by short-term speculation, is rejecting the necessary scientific pivot. This rejection ensures that the trillions invested will likely be wasted, cementing the crash, but also highlighting the immense arbitrage opportunity for those who are prepared to shift to the scientific truth of forward AI once the purge occurs.
We've established the scientific fact. The burst is a matter of when, not if, because the technology is fundamentally flawed. Now we shift from that engineering truth to the immediate market implications. If this inevitable financial reset is coming, how is the sophisticated money positioning itself, and what actions can the average investor take to prepare?
We are looking at elite conviction in the inevitable burst. The clearest, most public signal comes from the legendary short seller Michael Burry. His conviction is massive, and it is transparent. He recently placed a colossal $1.1 billion short position, specifically targeting key AI players.
We're talking about put options valued at nearly $1 billion on NVIDIA, NVDA, and hundreds of millions on Palantir, PLTR. That is a powerful market signal. He's betting on a 50% plus AI stock plunge by mid-2026.
Burry's move signals that proprietary financial models, the ones that leverage insights beyond what's in the public domain, are anticipating a violent reversal rooted in this lack of fundamental ROI.
This isn't just retail fear. This is the smartest money recognizing the structural failure. And this sentiment is echoed broadly.
Indeed. We see that skepticism reflected all across social media and financial discourse. Our sources show 75% bearish sentiment on platforms like X. You see serious investors decrying the hype factories and predicting a violent unwind, precisely because they recognize the circular financing and the massive debt exposure.
And that skepticism aligns perfectly with the projected timeline that was summarized in our analysis. And this timeline gives prepared investors a critical roadmap. Okay, let's summarize the when. Sources project that the initial tremors will begin in Q4 2025. This is when significant earnings misses will start appearing. Perhaps Meta's $60 billion in AI ads revenue lags severely, or other hyperscalers report higher than expected CapEx consumption with very little revenue to show for it. This is what sparks the initial 10 to 20% corrections.
The true collapse, however, is forecasted for mid-2026. This is when the bubble fundamentally bursts. The ROI drought, the validation of that 95% zero ROI pilot rate, it becomes impossible to ignore, leading to the massive $40 trillion wipeout on the NASDAQ.
And then comes the recovery phase, the post-2027 era. The survivors, purged of debt and obsolete CapEx, will pivot urgently to forward AI to QSANs, which finally begins the process of ethically adding the projected 15 to 25 trillion to global GDP.
For Wall Street, this is not Armageddon. It's the largest arbitrage opportunity in modern history. While Main Street faces mandatory exposure and devastation, those who understand the engineering truth can prepare, hedge, and profit. Success demands moving beyond traditional risk models and embracing dynamic, non-deterministic thinking.
So let's get specific. What are the key arbitrage strategies being recommended to the prepared investor? We'll categorize them for clarity, starting with preparation and portfolio defense.
The absolute first step is reducing your mandatory exposure to the nexus. You have to diversify away from the Magnificent Seven, which currently dominate the index weightings. The strategy is to reallocate towards stability and value.
Instead of relying on the growth narrative, we focus on safe harbors.
Precisely. We focus on what firms like Beaufort term safe haven stocks and defensive sectors. Think about traditional value ETFs, symbolized by tickers like VTV, and defensive sectors like consumer staples, XLP, and utilities, XLU. These companies typically have low price-to-earnings ratios, stable dividends, and they historically act as a buffer against deep tech crashes because their revenue streams are inelastic. People still need electricity and food, regardless of the Nasdaq's health.
And international diversification would help insulate the portfolio from the U.S. AI nexus risk as well.
Crucially, moving capital to non-U.S. markets, particularly emerging markets, EEM, or foreign industrial players less exposed to the specific debt and engineering flaws of the U.S. hyperscalers, that provides essential insulation. And fundamentally, you must maintain liquidity. Hoarding cash, raising your liquidity to 10% or more of your portfolio, is essential to provide the dry powder for the opportunistic buys that will appear at deep discounts post-crash.
Now let's talk about hedging the insurance against the downside vortex. This is where option strategies come into play.
The primary tool here is options-based hedges, which are designed for asymmetric protection. The most common form is protective puts on index trackers like the NASDAQ, QQQ, or the S&P 500, SPY. You're buying the right, but not the obligation, to sell the index at a fixed lower price.
So if the market drops 40%, you can limit your losses to 20%, for example.
Correct. You buy out-of-the-money puts, maybe 20% below the current strike price, which allows you to capture a potential 30 to 50% downside move, all for a relatively small premium, usually 1 to 2% annually. It's cheap disaster insurance.
Another option is the collar, which effectively pays for itself.
The collar is a zero-cost insurance strategy. You sell a call option, the right for someone else to buy your index shares at a higher price, which generates income. You immediately use that income to fund the purchase of the protective put. This shields you against significant drops, though the cost is that you cap your upside if the market continues to climb temporarily.
Are there simpler or more direct ways to hedge volatility without needing a deep knowledge of options?
Yes, through specialized exchange-traded products. For instance, inverse ETFs, like BTAL, which specifically shorts high-beta, high-valuation stocks. Or volatility plays like VXX, which tracks VIX futures and spikes violently during panic sell-offs. These can jump 50 to 100% in a deep panic, offering excellent short-term hedges.
And finally, how does one profit from the crash beyond merely hedging losses? This is the opportunistic short play following the Burry playbook.
You have to be highly selective and leverage the debt analysis we conducted earlier. The analysis pinpoints the most over-levered players, so you can target specific hyperscalers such as Oracle with its nearly $96 billion in debt and take short positions or buy put options, anticipating that the CapEx squeeze and debt servicing pressure will accelerate their decline. You are, in effect, shorting the failure of backward AI.
But the key here is not just the action, it's the modeling. You can't rely on the same flawed VR models that got the system into trouble in the first place.
Absolutely not. The success of this arbitrage, especially the timing of it, demands using risk models that move beyond simple historical extrapolation. You must leverage the principles found in Malhotra's work. Bayesian risk models that incorporate anticipation of surprise via forward AI concepts. You short the obsolete, and you prepare for the ultimate long-term play. Investing in forward AI pioneers and buying deep dips in cash-rich survivors like Amazon and Google post-purge, the ultimate, most resilient profit will be in pivoting toward scientific truth.
We've reached the end of this deep dive, and the findings drawn from the confluence of financial analysis and rigorous R&D are, well, they're stark. The symptoms, the 94% FCF erosion, the reliance on debt and SPVs, and that huge $525 billion CapEx gap, they're all rooted in a core engineering flaw, the structural obsolescence of backward AI. The correlation-based systems designed on unstable mathematics like SGD are predictably designed to fail in non-deterministic, high-stakes environments.
And the scale of this supergubble, amplified by the nexus coercion that forces Main Street exposure through index funds, dwarfs the dot-com era by a factor of 7. The scientific truth, championed by Dr. Yogesh Malhotra, confirms that the current trillion-dollar bet on GenAI and LLMs is fundamentally flawed and structurally unstable. The engineering facts, the facts regarding vanishing gradients and the failure to achieve causation, they ensure that a massive financial reset is coming. The question for you is, have you taken the necessary steps to prepare for the when, which is projected to begin with Q4 2025 earnings misses and climax by mid-2026.
The sources emphasize the consensus shared by Dr. Malhotra and even Grok AI that speculation and hype cannot overcome engineering fact. The insight that imagination knowledge highlights the need for a real scientific pivot.
The hype will inevitably burst, but the scientific imperative of forward AI, the Causation framework, endures. It promises to unlock $15 to $25 trillion in ethical, resilient global GDP growth post-purge. Given the overwhelming evidence of backward AI's predictable failures and the scale of the impending crash, we must ask ourselves a final provocative question. What structures, in your investment portfolio, in your professional life, or in your pursuit of knowledge, are you invested in that fundamentally prioritize historical correlation and simplistic extrapolation over genuine causation and quantum-resilient foresight? The greatest loss in a bubble is not merely the money, but the lost opportunity to invest in real, sustainable science.